United Health Group is down almost 50% in the past year. And if we zoom out to see the 5-year price evolution chart, we can see that this is by far the largest price drop that this company has seen in a very, very long time. Now, this has a lot of reasons behind it that we'll get into. We'll do a quick recap of what the company actually does and some of their financials. And of course, as we usually do, we'll be analyzing one bullish, very analytical article and one bearish opinion. This is so in the end we can actually decide whether we are bullish, bearish, if it makes sense to actually buy the stock, or if this could just be a value trap. Now, UNH is one of the largest, if not the largest, healthcare company in the US. They operate in different segments, the main ones being the United Healthcare, which serves as a healthcare insurance company, and the other one being Optum Health, which has different clinics and it provides just regular healthcare services. And as we can see, this company is a monster. Despite its price having suffered so much, it still holds a market cap of $250 billion, with a yearly revenue of close to $400 billion. Now, one of the things that this company has, as it operates in a very regulated and very low margin industry, we can see that its net margin the past year was of 5.4%, which we do have to say is above the market average. However, in our opinion, we usually like to look for companies which have a net margin of above 15%, as it can help with possible headwinds that will come eventually. However, since this industry is so regulated, it does make sense for UNH to have these margins, which closes a door for profitability expansion and for that margin to increase a lot further. But now when we look at their returns and efficiency ratios, these are looking very good, with the return on capital employed, which is the one we usually follow, sitting close to 19%, way above our threshold. After the big drop in price, their valuation has gone down drastically, sitting at a price to earnings of close to 12 times, and a price to cash flow even lower, 10.3. Now, this company does not have a lot of debt, as their EBIT over interest is 8.2 times. We usually like to look at this value above 10 times, but given that this is such a highly predictable revenue and free cash flow generating machine, this should be okay. And to finish off just the financial KPI analysis, they have a very juicy 2.2% dividend yield, which only has a payout ratio of 35%, which gives this a high security and a very high stable rating. Now I think the time has come. We're going to look at a very bullish article, which was very well written by Aidan Mertzel. We will put the link down below so you can check it out if you're interested in reading the full article. Just to give a quick summary, the article actually starts laying out all the reasons why UNH has dropped in price by so much, which are the earnings miss, the guidance cut, the CEO exit, and all the rising medical costs that they had just not expected. However, they still argue what we just saw, that they're still the best company in this industry and that they're trading at a very deep discount to their historical. And the fact is that currently their stock is not only at 52-week lows, but they're at 5-year lows. This article expands the issues that have caused this huge price drop and breaks it down into 3 main ones, which the author actually calls temporary. The first one is the Medicare Advantage utilization spike. And now, from what I've learned, since this is a medical insurance company, you pay them a subscription, we could call it, every single month, and in exchange, whenever you have to go to the hospital, they will pay you back and reimburse a portion of those fees. Well, usually what these companies do is that they have a prediction or a projection, more or less, of what percentage of their clients will actually have to go to the hospital that year and how much this will approximately cost the company. In this latest quarter, this medical care ratio, which is the number of people who actually went to hospital and got reimbursed by UNH, jumped to 84.8%. Now, last year was at 84.3%, so it's only a 0.5% difference. However, when you're talking about tens of millions of customers and very expensive medical bills, this percentage change can accrue very quickly and have a very large impact on the income statement, as it did in the last quarter. Another reason is that they're changing the risk model that they're using, and this is something that they use in order to calculate the prices of their different customers. Since this model was new and it needed some sort of recalibration, throughout the time it was working, it miscalculated reimbursements by around 9 billion. However, they believe that this will be a temporary problem. And last but not least is the DOJ investigation, which I think is more impactful than what they're stating here. Allegedly, what they have been doing is overcharging customers despite them not having a very high risk profile, which has allowed them to expand their margins and have them way higher than all of the other peers. The author argues that these settlements rarely exceed over 1 or 2% of annual revenue. However, let's remember that United Healthcare only has a net margin of 5% and that this is not all monetary. This can lead to very severe impacts from losing clients and just their overall brand being affected. However, they still argue that there are some near-term catalysts which will be able to boost the stock. Well, first one was the earnings that we just had, which since this was recorded above time, I'm not entirely sure how they went, but that is a big catalyst as the number one thing that had to be seen, how the earnings have gone and if they reviewed guidance or not. In theory, a Medicare Advantage rate increase has been recently approved, meaning that medical insurers will be able to raise their prices for next year, and it's a quantity that is higher than expected. However, just a side note, this actually raises red flags for me, because remember that one of our main criteria for analyzing successful companies is whether they have pricing power or not. Well, this actually shows us that United Healthcare, since it works in a highly regulated industry, is not able to do so and has very limited control over their pricing. Additionally, one of their catalysts that they argue is that some legal settlement clarity will actually relieve the situation. However, let's imagine that that legal settlement is way higher than expected. It would only make things a lot worse. Moreover, I understand how this industry can seem attractive due to the demographic shifts, aging population, and just the need to have medical insurance in the US can boost demand over the long term. One highly long-term catalyst, which he argues, and I had not considered, is that there are 32 states which are facing Medicaid budget shortfalls. Usually what has happened in the past in these situations is that they privatize their Medicaid services to managed care companies, and UNH historically has won more than 1/3 of these contracts. However, since this is a very long-term catalyst and a lot of things have to go wrong for this to happen, I believe that this is more like betting rather than choosing a safe and highly competitive company. When we break it down into their segments, the insurance portion of their business has grown their revenue by 12%, which is very nice. However, their margins were lower than expected to all the reasons we accounted for previously. On the other hand, when we talk about Optum, which is their care delivery clinics, we can see that this is growing at a way slower pace, with the revenues only expanding by 5% in the past year. And this represents almost half of UNH's overall revenue, which is why this stock is not such a fast grower. And now we get into the interesting part, which is their valuation analysis. However, this is mainly only a comparison of historical ratios. As we can see, they argue that currently they have a trailing P of 12 times and a forward P of 13 times, whereas historically, this is around 50% lower than the average. However, only by looking at this argument, we can make the point that, yes, but when else has UNH been in a position where one of their CEOs has been shot, another one has resigned in a couple of weeks, they're targeted by the DOJ, they missed on earnings, they have cut their guidance, and Medicare costs are only rising and thinning their margins even further. So we cannot compare today's UNH with United Health Group of 5 years ago when everything was a lot smoother and of course it was COVID time. The conclusion of this article is that this is a unique chance to purchase a top-tier compounder at very low valuations, and that possibly in 2 years this company will be back up to around their 420 and 450 price range. And on the other hand, we have the more bearish analysis, which is a lot shorter and basically states that there are structural headwinds and political risks that don't only affect UNH, but affect the whole industry. And on the other hand, there is just a lack of near-term catalyst for this stock to rebound anytime soon, unless this week's earnings blew it out the water. This article also mentions that it is very likely for there to be a lot more uncertainty surrounding this whole play for a lot of time, especially mentioning the reasons we already argued, with unanticipated higher medical cost utilization, overruns, widening regulatory probes, and just the abrupt CEO transitions. In order to deal with these two main structural headwinds, which on the one hand are political, due to mainly funding costs, and on the other hand are just industry related, such as the elevated enrollment and the utilization challenges, there are different kind of catalysts. The first one is that we have to pay close attention to the decision that is made on pricing adjustments for 2026, And the other one is that the stock will probably not move until we obtain clarity over the reviewed long-term projections. One thing that this article actually argues is that usually when stocks suffer so much, if there was high confidence in the ability of this company to be dominant and for the industry to still be relevant, there is usually what is called a V-shaped recovery. You can see it on many stocks that have had drawdowns, such as Google with the antitrust lawsuit. Visa and MasterCard have faced the same issue. You can see it with Salesforce, you can see it with Uber. There are countless of examples. However, in the case of UNH, it's almost as if the whole market was not convinced of the thesis, as there has been a huge drop in price and the stock has stayed pretty stable for the past couple of weeks, and it has even dipped even further. Which is what they're arguing, that the market has arguably just adopted a wait-and-see posture until things clear out and there is a bit more certainty. This is why, and I agree with this statement, that even if we agree on the fact that UNH is undervalued, buyers are just not likely to return until the bright side starts to show on the earnings of the company. So in my opinion, I'm not the biggest fan of this industry, I'm not the biggest fan of a highly regulated environment, and this is because I believe that there are just many more options that you can just get into which have growing tendencies, are unregulated, are growing faster, and are not having so many headwinds. However, on the other hand, for dividend growth investors, this can be an extremely attractive moment to actually get into UNH, secure that 3.2% dividend yield, and just ride it out because in my opinion, as much as I don't really like this company, I don't see it dying anytime soon. I think this company will still be where it is 20 or 30 years from now. They have a rock solid customer base, and it is pretty much a necessity. And just to compare their valuation to historics, we can map together their earnings yield and their price to earnings. The lighter one is the price to earnings, where their price to earnings is currently 12 times, whereas in March 2020, it reached a low of 14 times, meaning that, yes, currently they're in a bit of more trouble even than when we were in COVID times. But on the other hand, when we look at their earnings yield, they're currently yielding an 8.5%, whereas on that same day, they had an earnings yield of 7.4%, showing that they have been in similar valuation styles and it has played out fine. However, I don't believe that that circumstance was the same as what they're facing now. So while I believe that this could be a great entry price for those investors who are extremely confident and knowledgeable about this industry, and who believe that these issues or headwinds are only temporarily, I believe that this stock could still be down for a long time, and that there are safer opportunities which could offer a much higher return. And just because of that, I believe I will stay on the sidelines. I maybe just keep watching the developments to see if when there is less uncertainty surrounding this company, it may be worth a stronger buy. So I hope you enjoyed this review. Please let me know if there is anything I could do better for the next one, or if there are more companies which you would like me to review. And as always, thank you for watching. This has been the Cashflow Compounder. Join the free Patreon for extra content, and I will see you in the next one.